you can defer tax on the real estate sales, obviously through that 1031 exchange. What we've done is taken advantage of the bonus depreciation and accelerated depreciation. So
thank you so much for tuning in to Journey with Christian D. Evans podcast. I'm your host, as always, Christian D. Evans. And guys, we have a very special guest. If you're one of those individuals that want to pay less in taxes, we all do. They want to create passive income through real estate. You want a guidance about selling your company, which is most of you guys are wanting to exit at some point. You need some guidance to navigate through that. Or they want to upgrade your financial team. Having the right solidified individuals, A players on your team to really help you grow and sustain and preserve your wealth. Well, that's the reason why I have this next guest on. He has built Family Freedom Office to help entrepreneurs produce predictable income, create their ideal life, and build their legacy. They are a registered investment advisory firm, operates as a multifamily office. They advise your guys' family as if it were your own family. Their ideal client has built a successful company, accumulated 8-figure net worth, and wants to run their money like they run their business. He is also very, very well established, 40 acquisitions in the real estate market with $700 million in their portfolio, and a financial advisor to the 0.5%. Please welcome the CEO and founder of Freedom Family Office, the one and only Noah Rosenfarb. How you doing today, Noah?
thanks so much. I'm doing great. Thanks for that kind introduction.
Well, Noah, I'm really excited about diving into this because one of the things, before we dive into all the strategies and the planning and the navigation, all the fun stuff we're going to be talking about, in your bio, you talk about how helping individuals that, you quote on this, you helping families cope with divorce. You encountered entrepreneurs that ultimately prioritize their desire for success over the needs of their parents, resulting in divided wealth and lackluster portfolios. And I thought that was really interesting. So help me understand a little bit more about how, by helping individuals work through divorce, reallocating their wealth, and all that frustration, how that has pivoted the way you think about wealth, preservation, and legacy, Noah.
Yeah, and maybe even the story goes back to my own family and my parents' divorce when I was 3. But what I've seen over time is that a lot of entrepreneurs are so focused on their financial goals and their business goals that they deprioritize their family goals and their relationship goals. And so that's really influenced our philosophy of becoming rich beyond money, which is really not only having that financial freedom, but also managing your calendar in a way that brings you joy, and then finding the meaning and purpose in your life that goes beyond, yourself and your family.
And how have you, because you mentioned, obviously one of your priorities and one of your LinkedIn posts is really building a legacy, but also your wife and your kids. And have you always been that way, Noah, or has that been an evolution as you become a very family man and prioritize that?
Total evolution, yeah. My wife's been a big help in that one. I would say from, a young child until we had our first child, my primary focus was money and business and not necessarily relationships and family. And my wife, when we had that first child and we did turn 30, and one of my goals was to be a millionaire at 30, which was something that we were able to achieve. And she said, Noah, there's no reason to keep running so fast because I don't think you're headed to the right destination. And so she helped slow me down and, make sure that we could appreciate the things that we had in our life now and not just work towards some future goal that may or may not come.
So with that, I want to get a little bit more personal. How did that hurt your pride or restructure your pride and embrace humility to, use that as your foundation and your North Star?
I think it helped me redefine what success meant. And historically, I guess, growing up, I always thought of success being measured in dollar terms, in net worth, in income, in possessions and experiences. And I didn't really think about wealth or money or being what we now refer to as rich beyond money as that, having your time to spend the way that you want, having the impact on the people that you want. And of course, I still believe that financial independence is a high priority. and it's something people should strive for and plan for, but not in an absolute vacuum.
See, what I find so interesting, and that's why I wanted to kind of talk a little bit about this, because it becomes the DNA of what you guys represent at Freedom Family Office and how you facilitate these relationships. And so I appreciate you kind of, unpacking that a little bit further. So let's kind of dive into the exit strategy. You mentioned on your LinkedIn post, and I'm very guilty of this as well. When I had my exit, I called people, and tax strategists after the fact, and instead of, pre-exit. And Noah, first of all, I want to talk a little bit about, when someone is looking to exit strategically, okay, there are certain things that can be established and need to be established prior to the exit. What does that time horizon look like normally? I know it's really contextual depending upon obviously what company, what they want to do, what their goals are, but what are you noticing? Like, should they reach out to you 2 years prior to the exit, or maybe even before they're even thinking about an exit? What have you noticed is the prime time horizon?
I'd say it's never too early, and if you're probably 6 months away from interviewing investment bankers, that's about where it starts to become too late. So, if you've already hired your banker, if you're already going through fireside discussions, if you're already got your first LOI, there's still some things you could do, but you should really pick up the phone today, immediately. And I would say, if you're 6 months before you're hiring a banker, anytime before then, you'll be in good shape, but it's never too early to get started.
So let's talk, I know some of these questions, there's certain opportunities here in regards to tax incentives or tax strategies. And Noah, if you could maybe give us some case studies or certain circumstances or some families that you've worked with. I know you won't be able to say their names or the numbers or whatever, but like say, hey, this was the situation, this is what we did, and this is how we were able to help them navigate the exit strategy to have an effective, mitigated tax bill.
Yeah, and I would say it's very family dependent. It's time dependent on when they reach out to us. It's also based on their structure, their company structure, the way that they're likely to get acquired, whether they're going to be an asset sale or a stock sale. If they're selling to private equity versus a strategic, often those would have different deal implications as well. But I'll give you maybe 2 examples that I think would be powerful. And you may have some kind of deeper dive questions as I go through the fact pattern. But in one case, we have a proprietary tax strategy, proprietary meaning we're the only ones that implement it, and something unique to us, where in addition to providing estate planning and asset protection during the planning process for the sale of a business, we can also avoid the capital gains tax on the sale of that company, as long as it meets certain prerequisites and requirements. And so we were able to take a client who was going through the sale of about 50% of his equity and drop it into this structure. The net savings for him were quite significant. He was able to avoid 100% of the tax, but that came at a cost of the structuring, which is maybe about 20 to 25% of the taxes that he would have otherwise paid. And what's interesting about this proprietary structure is that the future earnings on the additional equity that he still has, which is going to come out to him every year in the form of distributions, but also taxable income, he's not going to have to pay any tax on that ordinary income either because of the structure we've created. So super powerful, not appropriate for everyone. It's really designed for an 8-figure exit, usually better for C corporations than S corporations, and there are some other deal factors that are specific. But if your deal wouldn't meet those types of parameters, we have another structure that we use, which is not proprietary. It's not what many people think about when they hear of installment sales. There's a monetized installment sale, which is on the Dirty Dozen list for the IRS and is currently in the middle of litigation. But we use an installment sale without a monetization component. And what that does is it allows the seller to defer their tax up to 30 years. So great strategy that we often use for people who don't want to pay the taxes now. There's a cost to that structure. It's usually around 6%, so that the seller retains 94% of the sale price, as opposed to if they were in a high income tax state, maybe only 65% of that sale price, or if they're in a no income tax state, maybe 78% of that sale price. So you can compound more of your money and provide you with an additional return. It turns out, assuming capital gains tax rates stay about the same, that you could have about 16% more income and assets through that structure.
So what you're looking at is when you're having an exit, your North Star is really just mitigating that tax. And there's a lot of different ways of obviously taking the distribution aspect, like you mentioned, the proprietary method, but also the non-proprietary method, and the way to structure that out. With the tax constantly, changing, and you mentioned this in one of your LinkedIn posts, with the tax strategy constantly changing from, Trump administration to the Biden administration, vice versa, and whether you're liberal or Democrat, it doesn't really matter. It's a matter of just the tax are always constantly living and breathing, and there's always going to be things changing, adjusting. How do you guys, what is your methodology and the way you think about it in regards to navigating this as things are changing at a macro level that you cannot control?
And I'll go back to one thing you said around the tax strategies being the motivation being paying as little in tax. I'd actually challenge that and say our philosophy is really to help entrepreneurs achieve their goals and get clear on what those goals are. Oftentimes, part of achieving those goals is minimizing taxes. For other entrepreneurs, it's not. We had a great exit last year with one of our clients, a healthy, $70 million exit, and he decided he'd rather pay $13 million in taxes because he felt like, this is an achievement of a lifetime. I did it here in America. I'm happy to contribute and pay my fair share. And God bless him, that's what made him feel most comfortable. We don't try and impose our values on our clients. We try and listen to the clients and understand what's important to them and plan and design for that. And so with that as the guiding light, what we really try and then do is say, if you have an aversion to paying tax, if you want to keep more of your money that you've earned yourself, the best way to start doing that is by planning now for whatever that future is going to look like. And the more you could take advantage of existing tax laws while they exist, strike while the iron's hot, because you never know which loopholes are going to close with each administration. And so you want to take advantage when you can. And, I could give you some examples if that's helpful too.
Yes, please give us a few examples that you've noticing people have taken advantage within the last few years, and I think I know a few, but I'd love for you to get your response, and then as well as what you're seeing in, that are coming down that people should be aware of in regards to advantageous strategies.
So something clever that I came up with, a strategy that I co-invented with a Caribbean tax expert, was I created a business in Puerto Rico because Puerto Rico created some tax incentives in 2012. And what they wanted to do was provide incentives for people to create their business on the island or to move to the island to receive their retirement income or their current working income. And I didn't want to move to Puerto Rico. I've got a young family. I enjoy living in South Florida. We didn't want to move. And so it took me about 2 years to figure out how I could leverage this law to my advantage, because I didn't think it would be around forever. And in fact, the agreement that I have with the government is only a 20-year agreement. So even for me, even though I did make an agreement, my agreement only requires me to have one employee in Puerto Rico. They've changed the laws. At points in time, they needed 10 employees. So I got in it right at the right time when you only had to have one employee. There were times where they required you, if you went as an individual, to buy real estate. There were times that they didn't. So it's looking at those tax laws to see when is the right time for me to jump in and take advantage. Now, when I took advantage of this, I knew that I wasn't going to be able to break even on my return on investment of just costs and fees to get the structuring done for at least a year, maybe even 2. But now that I'm like 4 or 5 years into that structure, my business, which pays a 4% corporate tax, is owned by my Roth 401k, which is a unique tax strategy as well, called the ROBS plan, ROBS, Rollover Business Startup. And so when I make, let's just say, $1 million in my Puerto Rico company, I pay $40,000 in taxes, and I issue a $960,000 dividend. My brother, who lives on the island, pays no tax on that dividend because he's a resident. and my dividend goes into my Roth 401k. I pay no tax on that. And then I invest it in real estate, in private debt, in securities. And if I have income, interest, dividends, capital gains, I pay no taxes because it's inside my Roth 401k. And eventually, when I'm 59 and a half, if I want to take that money out, I can take it out tax-free.
Interesting the way you structure that. And so I'm just intrigued by how you structure these different vehicles and you think about it holistically. Is that opportunity still present? Because I do know some individuals, move from California to Puerto Rico for that specific situation. But you're in a situation where you actually had a host at a business, but you still live and your residence is in Florida. And so you're still able to take advantage of that, remotely, if you will.
Correct. And let's say I didn't set up that Rob's plan component, which is owning the business inside the 401k, and instead I wanted to live in California. Well, when I make that $960,000 dividend distribution as a California state resident, I'd have to pay federal dividend tax and California dividend tax. So I'd pay my 4% in Puerto Rico. I'd probably pay around another 30% or so. So I'd be at 34%, which probably isn't much. It's certainly better than what you'd be paying on a corporation in California today, or even an S corp with pass-through. You'd probably save about 30% of the taxes, even if you didn't move to Puerto Rico.
Well, I think that's what I was talking to a friend of mine, and he was looking at the cost ratio a little bit as well. For the complicated instruments, sometimes you have to establish, whether it's funneling through a trust or a fund or whatever it may be, for tax advantage, processes. And sometimes you do have to identify, because the tax code is changing, adjusting. How do you navigate that accordingly? Like you establish, I was talking to a friend, and he was saying he established something for the tax code a few years back. It was established, and then obviously the tax code changed, and it was not effective anymore. So, and then they had to kind of tear down the whole trust and whatever, and there was a whole complicated process. Right. So how do you navigate that when there is something that's okay, it's working, and all of a sudden something changes that you can't control, and then obviously just navigate it from there? Because that's just the real world of life.
And I would go back to more of that philosophical approach and say, each taxpayer has to understand what risks they want to take when it comes to their self-reporting as a taxpayer. So some people say, oh, you know what, I deduct my cell phone bill. I make personal calls off my cell phone, but I deduct 100% of my cell phone bill. I think everybody agrees that's somewhat realistic. Maybe some people go to a trade show in Vegas and they go out to dinner and they deduct the meal and they deduct their hotel, and maybe they stay, an extra night or two that they didn't have to, but they deduct that also. So we all get to decide what level of audit risk we want to take, how much of our income and expenses we're self-reporting. When these laws change, or when you're looking to plan around a certain set of tax laws, you want to think through your ROI, not just in the cost, but in the complexity. And so what's happened over time, and I'll use my own family as an example, is when I started in the realm of having more complexity, it started with self-directed IRAs investing in private real estate investments. That's pretty run-of-the-mill type of tax strategy. Certainly created an advantage for me and my family. But over time, having 4 different separate self-directed IRA LLCs investing in a variety of different deals, and then having my new 401k plan, which also has a level of complexity, and then establishing trusts and domestic asset protection trust, spousal lifetime access trust, the complexity starts to get significant enough where I need a team of people to manage it, which is why I built a family office. But as I've done that, I'm trying to reduce the smaller complexities that didn't add as much value that I started earlier in my life, kind of closing them up to focus on taking the where I'm willing to add complexity, I'm also adding a lot of value.
Now, I know you obviously have a huge portfolio in the real estate. Real estate is very well known for opportunities in regards to, really destroying that tax bill pretty quickly with depreciation, accelerated depreciation, all those different fun things you can allocate. Outside of real estate, because I know you're an expert and we're going to be diving into that here shortly, but what other strategies, that are very effective in the alternative investing space. I know you mentioned in one of your LinkedIn posts, talking about opportunity zones. That's kind of coming to the end of the timeline of that. But it was very effective. People took opportunity and they infused capital in that, and they took opportunity of that. What are you looking at in regards to structuring in that alternative investing space that ultra high net worth and high net worth individuals are allocating their capital to for not only growth but preservation?
So one structure that a lot of families aren't exposed to is referred to as private placement life insurance, PPLI. And what PPLI does is it enables you, because of the power of the life insurance lobby. Most people don't really grasp how incredibly powerful life insurance can be as a strategy. I'll share a quick story. I met a 9-figure net worth family, really buttoned up. They I looked at their stuff and I was like, wow, you guys, you're really impressive. They had no estate tax that would be due. All their trusts were properly structured and everything was essentially properly titled with very few errors. But I said, where's your life insurance? And the second generation kind of new leader of the family said, my dad has some life insurance, just because he had to get it for the bank a long time ago, but we don't need life insurance. I only had life insurance because we needed it. And I said, the fallacy is that wealthy families don't own life insurance because they need it. They own it because it's a good investment. And he tried to call me to the carpet on that. And what I was able to do was show him how he and his wife could obtain a $63 million life insurance policy with very little money out of their pocket. They paid about $180,000 a year worth of premium. And the rest of the premium, $22 million worth of premium, was paid through a bank loan. And they posted some stock that they own that they didn't plan on selling, Amazon, Google, S&P 500 index fund. They just held that in a collateral account, and that policy's performed quite well. If they had died prematurely, it would leave 40-50 million to their kids, income and estate tax free. If they live to their life expectancy, it should leave about 30 to 40 million to their kids and grandkids, income tax free and estate tax free. And so I think that's a strategy some people are unaware of, as to how to leverage life insurance. In these private placement policies, you can own alternative investments, so you can own things that are highly frequently traded where you'd have short-term capital gains and pay no tax because it's inside of a life insurance policy. So private placement life insurance could be an interesting strategy. I also think the self-directed IRAs or the self-directed 401ks, like I was mentioning before, those are great strategies. For me, I do a lot of private lending. And so when I make loans, I'm generating anywhere from like a 10 to 14% average annual return, which normally would be taxed at ordinary income tax rates. But because I do that inside of my retirement plans, I pay no tax. So I'm able to compound at that 10 to 14% return, totally tax-free.
So with the life insurance specifically, I want to dive into this, and I want to talk about the deferred, which is really interesting. But with the life insurance, I'm very familiar with it, but how do you look at it? Is there a, when you're looking at residential, it's like 10 times what you bring in. So if you bring in 50, you normally need $500,000. If you bring in 100, you need $1 million. Whatever it may be, like that's kind of the ratio, if you will. How do you look at it in regards to the higher net worth, ultra high net worth, when they're looking at all the assets? Like you mentioned, you explained the structure of it, but if they have $100 million in assets or $10 million in assets, what does that ratio look like in regards to how much you need to cover, not only, because like you mentioned, it does come in tax-free on the federal and the state, which is really, really important, and I don't think a lot of people understand that. And then two, also, Noah, the misconception in regards to term versus whole life versus universal. There's a lot of misconceptions behind those kind of different vehicles, and each one is very, very valuable. So first question, the second question for me, Noah.
I'd start by saying life insurance is typically taught by people who earn commissions when people buy life insurance. And so because that's really the sole place that consumers get their education, there's this inherent conflict of interest. And so it's hard for even sophisticated entrepreneurs who get exposed to life insurance concepts to trust the person that's educating them, because they know if they follow their advice, that person's going to earn a commission. And in contrast, most people who refer to someone as their financial advisor, if that financial advisor doesn't collect insurance commissions, then typically they have a negative attitude towards insurance products. I don't know, again, if that's just the conflict of interest that if you manage money for a living and now your client's going to take out $1 million a year to pay life insurance premiums, you now have $1 million a year less that you're earning fees on. And so maybe you want to turn a blind eye to thinking that that might be a good investment for them. So I think the conflicts of interest are inherent everywhere, and it's important for entrepreneurs to understand how they're getting educated, who's educating them, and whether or not they can really rely on and trust the advice that they're receiving. So with that as the precursor, I would say that life insurance is this great tool that can be very powerful for a whole bunch of different use cases. One is the term insurance. I have my kids. When I had my child, I decided I needed some insurance if something were to happen to me. My wife, I wanted her to be able to continue to stay home and raise our family, so I needed enough insurance because I didn't have enough savings by then. Later in my life, I used permanent life insurance as a way to store my cash because I thought it was better than putting my cash in the bank, and that's proven to be true. And then as my life continued to evolve, and I got to a point where I didn't really need insurance death benefits to pay estate tax, to help my family survive in my absence, I was really using insurance for an income stream in retirement. So I bought insurance where the bank paid 75% of the premium, I paid 25% of the premium, and through that investment, I paid $30,000 a year for 5 years. I should get about a $90,000 a year tax-free income stream in retirement. Then I did that on my wife. I've had my brother do it. I've had my business partners do it. It's a great another arrow in the quiver. And then, like I mentioned, for some families that want to build a dynasty and want to create dynastic wealth, this concept of premium finance life insurance where the bank's paying 100% of the premiums, they can get these monster policies. In the case of the family I was telling you about, that should add about 40 to 50% to their net worth that they leave to their kids. So, really powerful tool.
And it's just leverage. That's incredible. High leverage. That's remarkable. I didn't realize you could do so much with that life insurance. I appreciate kind of unpacking that. We're talking a little bit about also real estate, but also you mentioned obviously the way you structure it. You got some really intriguing ways of how you structure these things and how you think about this, because you're obviously on the forefront of this and you know the code in and out. So when you're talking about obviously deferring those dividends, explain that a little bit further and how you structure that out to obviously optimize that mitigation.
So specifically with these installment sales where you can defer your taxation, is that what you're referring to?
Well, the real estate side of things, yeah, you were mentioning on the second part where you were talking a little about where you were able to structure it out, where you were able to defer that out. Explain that a little bit further for our audience.
So on the real estate side, one of the things that we haven't done in the last handful of years is what's referred to as a 1031 exchange. And that's probably the most common tax code related to real estate that people are familiar with. It allows you to sell an asset and take those proceeds and buy another similar asset, another investment property, and you can not pay any taxes. And it's a really magical section of the tax code combined with a whole bunch of other real estate related tax benefits and reasons that so many wealthy families own real estate. When you study ultra high net worth families, you find about a third of their net worth is usually in real estate, and most of that being investment real estate, not personal real estate. So one of the ways that you can defer tax on the real estate sale is obviously through that 1031 exchange. What we've done is taken advantage of the bonus depreciation and accelerated depreciation. So in 2013, I bought a building in Arkansas, which I sold in 2018. I had a capital gain, but I bought a new building in Atlanta. And when I bought that building in Atlanta, 75% of my investment was reported as a loss on my K1 in 2019. And it just so happened that was the same amount of my capital gain from the asset that I sold in 2013. So I didn't have to pay any tax on that 2013 sale. Now I have a new 2019 asset. It just so happens I'm about to sell that 2019 asset in the next month or two. that'll result in a significant capital gain. But again, what I'm doing in 2023 is I'm buying more real estate using the depreciation to offset my capital gain. So as long as I continue to invest more money in real estate, not less, then I'll always have these losses to offset my gains.
So this is where I think about this game specifically is, I've got some individuals that deployed a lot of capital in the private equity as well as, direct deals or like secondaries. And the thing is obviously you and I know that that's maybe a 5-7 year illiquid period. But when they have a liquidity event, obviously you're expecting a large return, a good, internal rate of return. So basically and I just want to make sure I'm kind of picturing this out. A lot of what they do is when they have that liquidity event, maybe just makes math simple, they get $1 million back after they give it $1 million. So now they brought it $2 million. Wonderful. Now what happens a lot of times is like what you just explained, Noah, is then they come over here and deploy capital into the real estate side of things. And what happens is they may do syndication, they may do direct deal, whatever it may be, but now they've accelerated that depreciation by quite a bit, so that $1 million normally would be taxed as a capital gains, which would be 20% plus whatever state you're in. But now because of that, you're over here and saying, hey, now accelerated depreciation, now these individuals can really not, decrease that tax bill by a tremendous amount, depending upon the size of that real estate investment. And that's how the wealthy are able to pay no tax at all, even kind of remove themselves away from the capital gains because they leverage the real estate, real estate game in that manner. Is that correct?
Yeah, I'll share kind of two maybe more nuanced points to that. So a real estate professional is a tax status that is also self-reported. I've been a real estate professional for 23 years, 25 years, and it's a self-reported tax status. In order to report that tax status, you need to meet a 5-pronged test. The two most important points of those tests are, one, it has to be 750 hours or more of involvement in real estate. And the second is that it should be more than anything else you're doing. So you can't do anything more than you're doing real estate. And then there's 3 other tests as well. So if you meet those tests, you could be a real estate professional where your real estate losses offset not just your real estate income, but really any income. And so that's one of the code sections that I always take advantage of. My family office is a U.S.-based business. I mentioned before my Puerto Rico-based businesses. But my family office, I generate U.S.-based taxable income, and I want to make sure I'm buying enough real estate not just to offset my real estate gains, but also my ordinary income from my family office earnings. And I do that as a real estate professional. If you're not a real estate professional, if you're investing in syndications as a limited partner, then your real estate losses only offset real estate gains. Now, some accountants will let you offset those real estate losses with other gains that you have that were passive. I don't believe that's the correct interpretation of the tax law, but taxpayers are doing it all the time. Again, it's one of the benefits of our self-reporting system is you get to tell the government what the results are, and it's only if they come back and ask you some questions that you've got to defend yourself.
So, and I appreciate that differentiation in regards to syndication versus direct deal. Direct deal is obviously, going out there and you can obviously take all the added benefit, but the syndication, it's only for real estate losses. Just want to make sure I understand that correct. Okay.
Yep.
Gotcha.
Yep. Correct.
So with that being said then, I want to talk a little bit, pivot back to the businesses when they're exiting. I had a friend of mine that was going to exit, and before he exited, he had to reestablish the HQ, which was in California, to I forget where I think he's stationed. I don't know if it's in Florida or if it's Delaware. But anyways, my point is he had to move the HQ because he knew the tax on the back end was going to be devastating. And I want to talk a little bit about, how to think through that process in regards to when you are in a state and you are looking to exit, maybe an 8 or 9 figure, there are certain things that you have to obviously establish. We just kind of talked a little bit about that, but also, just making sure that you have all the right infrastructure established.
Yeah, I would say anytime that you start to get towards that $1 million ordinary income level, you want to go beyond your current tax preparer and your current CPA firm and get counsel of a tax strategist. So in our family office, one of our team members is our chief tax strategist, Chris Hines. He's educated not only as a financial planner, but also as a tax attorney. And so he provides tax strategies to our clients so that we can look at it holistically. Because again, if you've got a C Corp in California, you may prefer to take on this proprietary tax structure and not have to move your headquarters and get perhaps a better result than moving your headquarters to Delaware and still paying the federal tax. So it's looking at it holistically. And I would say, again, it's that tax strategist who's often educated as a tax attorney. So not someone that's focused on tax litigation, but someone that's focused on tax strategy. And what they're going to do is they typically have a much broader outlook on the course of affairs from where you are today, making that $1 million plus of income, to what the future is that you're thinking of creating, whether that's selling in 3 to 5 to 10 years, whether it's holding this business forever, whether it's making $100 million a year or $10 million a year, and how you want to spend those proceeds. And so thinking through that general tax strategy is what's going to help you with all the tax structuring. Most accountants are really much better at looking in the rearview mirror to report what's already happened. And then usually if you do meet with them in the third or fourth quarter, they might tell you if you want to accelerate expenses into this year, pay them now, not pay them next year to reduce your taxable income, or hold off on invoicing until January because you want to reduce your income for this year. So that's what most CPAs are looking at, is this year, next year. What most tax strategists are looking at is the broader kind of time frame of how long are you going to own your company. And when we do our work inside of our family office and we develop tax strategies for families, we're really looking sometimes 2 or 3 generations down the line.
See, and this is why I'm so glad we pivoted this direction, because in your step 2, you say, where do you want to be? And then step 3, how will you get there? And, you know, we talked about the first step, which is kind of where are you now? Unpacking kind of the thesis, your financial statements, your current estate plan, et cetera. Where do you want to be? What I found interesting is you have to be clear on what that path looks like. And Noah, what I've talked to is it's hard for people to think generation 2, generation 3, let alone, you know, a week from, you know, today, right? So I'd love to ask, let's talk a little bit about how you are able to help your clients think generation 2, generation 3, and establishing that plan, but also giving flexibility for the evolution of the plan.
So it all starts with an exercise that we created called True North. And we sit down with in most cases, a couple. Oftentimes one of those spouses is actively engaged in their business and the other spouse is not. Maybe the spouse that's actively engaged in the business is actively engaged in the financial planning and the other spouse may not be. But when we talk about what is it you're trying to accomplish in your life, that's a conversation both spouses want to have together. And so we encourage, that's really where we start with every family, is what is it you're trying to do? Where is it you're trying to go? What are you building? And by eliciting that conversation in a structured way and coaching and guiding them through the exercises that we've developed, we help families gain that clarity of what that true north is for them. And what is most interesting, and it's certainly been my experience, is that more of the 4 key questions that we'd ask that your audience could just write down the answers to is, if money were no object, if you went out and you bought a lottery ticket and you won $300 million, so take money off the table, who would you spend more time with? And who would you spend less time with? And what are the things you'd start doing? And what are the things you'd stop doing? And if you take the time to answer those 4 questions, my guess is 80 to 90% of the answers will not require you to have more money. They just require you to be more intentional on where you're investing your time and often what you're going to say no to. And so, we try and help lead clients in that direction so that they can start focusing on what really is their priorities in life.
So, and what I find so interesting about that is obviously as they evolve, the answers evolve as well. Because obviously something, 4 years ago, your answers obviously are today are going to be different than, 5 years from now. So Noah, as someone that's able to help facilitate the right vehicles, right, the wealth strategies or the right different vehicles for them to produce and preserve and grow their wealth naturally for their generation 2 and generation 3, how do you guys, because obviously you mentioned those asking those questions, but how do you establish the right flexibility in their plan and strategies to make sure that as their answers evolve, throughout their life, the strategy or the plan evolves with them in the proper way?
So one of there's a great author and thinker on this topic. His name is James Hughes Jr. He's a seventh generation lawyer. And what James wrote about very eloquently and really influenced my thinking was around the difference between a gift and a tax structure. And when parents use tax structures as ways to mitigate taxes that require them to end up giving money and control to their children or grandchildren, that often creates problems and conflict. But when parents make gifts to their children and do it in ways that are tax structured, they tend to have much better outcomes. And I think what in practical terms, what that means is that some families, they have, newborn children, young adult children, children that they certainly wouldn't want to hand over 8 figures of net worth or 9 figures of net worth to because they're not developed enough. But they've been convinced by lawyers and accountants to reduce their estate tax potential by giving assets into trust for which their children will be a beneficiary. And I think that's misplaced guidance. I think that, I'm a big proponent of paying in little as tax as humanly possible, but I'm also a big proponent of not transferring wealth to people that don't know what to do with it, because money that isn't earned can be more of a weapon than a tool. And we want to make sure that we're doing the education of our families so that we have confidence that we can make this gift to them and the gift will be a blessing and not a curse.
So how do you have that conversation? How do you structure the right boundaries and systems, just like you said, to anticipate that may or may not happen, and to make sure that there are the right boundaries and systems, leveraging these vehicles to ensure that the wealth is preserved long term to hit generation 3, generation 4. I talked to another family office, and they say that the lifespan for generation 3 and generation 4 are exponential small, like 5% only last till generation 4 in regards to wealth. So,
right.
Just like you mentioned, when you give someone a lot of money but they don't have the right mindset, well, they can either dig a very big grave or they can build a very big mountain. It depends upon how their mindset is in regards to the wealth and the way they structure it. So what boundaries and systems to ensure that, like you mentioned, that misplaced guidance, how do you navigate that with your clients?
We try and encourage families to have family retreats where they have an agenda that's focused around their family values, that's focused around what it means to come from this family, what it means to be a steward of the family's wealth. Not every family is that interested, and so again, it really depends on the goals and objectives of each individual family. Some people are very focused on making sure that their great-grandchildren can afford a college education or can live, go to private schools or do certain things that their family has been accustomed to doing, stay in a lake house, fly on their private planes. But most of our clients are 8-figure net worth. So we have some 9-figure net worth clients, but I would say the bulk of our clients are in that $10 to $100 million net worth range, where for some people they may believe that that's an endless supply of money, and for other people they believe that you're just kind of entering the level of ultra high net worth. It depends where you come from, depends how much you like to spend money, and depends what you want to do with it. And so for some of those families, they don't really see how their $40 million at age 55 can turn into, $200 million by the time they die. They just don't really believe the numbers and what the impact would be. And so we just have to wait and be patient. And a lot of times, it's when the student is ready, the teacher appears. And so we're there to guide our clients, to help them with the issues that are most present on their mind today, and to give them a glimpse as to some issues that we foresee that might be of interest to them. But usually it's on their timeline where we'll do the implementation. We can't push that rock uphill because it takes a lot of thinking, and it's only worth the entrepreneur investing that thinking time when they believe it's critically important to them.
Gotcha. That makes sense. And I want to ask, when you're having these conversations, like you mentioned, where, growing that wealth a little bit, I've noticed a lot of families that exit out of, like, let's say, for example, a telecommunication. They like to, when they have established their wealth, they like to infuse that capital back into telecommunication companies of some sort because they're familiar with that industry. They don't like to, we've all heard of diversify, but they don't like to diversify too much out of the industry because they're not familiar with those other industries as much as they are familiar with the industry that they made their wealth in, which obviously through logic, that does make sense. However, though, sometimes if you don't infuse some capital in real estate or other avenues or vehicles, then you are relying just on that thesis a little bit. So when you're having that conversation, do you gravitate toward that thesis in regards to, hey, if you made your wealth in consumables or telecommunications or whatever it may be, right, manufacturing, then stick in that thesis where you're familiar with? Or do you say, hey, let's go ahead and leverage some other, experts, players on your team that are able to help you diversify that wealth so that you don't rely on that one industry? How do you think about it, Noah?
I think most entrepreneurs concentrate to create and they diversify to protect. And so the reason for the diversification is to say, okay, I'm comfortable where we are. I don't need more, but I don't want less. And so how do I preserve and protect what I've built through diversification? And that's often what we're doing, I would say, most effectively as a family office, because people are coming to us usually at a time where they're done with their concentrating to create phase of wealth accumulation. And now they're in that wealth utilization phase where they want to take all the fruits of their labor that oftentimes required sacrifices that they don't want to make anymore, and they want to start living their best life, and they really want to do all the things that they wish they would have done sooner. But the concentration, let's say people do stay in an industry, usually the reason they're staying in that industry is because they're also contributing non-financial capital to the company. They're contributing their network, they're contributing their brain, they're contributing their time. And so that concentration requires effort. Whereas when you diversify, you limit your effort. So when you invest in a portfolio of stocks and bonds, when you invest as a passive investor in real estate syndications, there's really no time requirement involved. So you can spend your time in other places. And I think that it goes back to what is the motivation of the family that we're counseling? Do they want to continue to invest their time building wealth? Or are they now at a point where they want to shift their attention and focus maybe to mentorship, to building stronger bonds within their family, to supporting noble causes? And as you shift into that realm of more meaning and purpose in your life, you may not want to spend your time as much working in these concentrated areas. But, again, I would say most of our clients are financially independent, never retired. They're always going to be making deals. They're always doing something of interest. They don't want to just sit on the beach and sip margaritas.
And so it's a graduation. Once you get to that level, then it's obviously your focus and your North Star becomes just slightly different than, obviously, like you mentioned, growth. I want to talk a little bit about emerging markets as we've come into 2023 and onward throughout the 2020s. One of the things is we've noticing more of a flow of everybody really engaging, right? People are deploying assets and capital in Saudi Arabia to obviously Europe and all sorts of different emerging markets that are very, forefront of technology or, just different opportunities. With that being said, I do know that we're talking about really the 0.001% that are able to actually, take access or have ability to, deploy capital in that. But no, with the individuals that you've talked to thus far, have you noticed where they deploy maybe a small percentage of their wealth into emerging markets to be able to, at least play the game? Or have you noticed majority of them still kind of allocating most of their capital here in the States or more, North America broadly?
I'll share with you my family's asset allocation, and then I'll kind of delve into, more generalities. But I've always taken all of my emerging market exposure through publicly traded investments, and I have not done any private investing outside the U.S. And there's a few different reasons for that. I would say the primary driver is that the expected rate of return in other countries in private deal flow is not necessarily significantly greater than what my expectations are in U.S. privately held investments. And so if I'm going to venture, I just was doing due diligence on a deal in Vietnam, and I look at international deals all the time. And it was a land development deal, building out some condos and selling them, high-end condos in a suburb of Vietnam where things are expanding into. And the projected returns were about the same as what the projected returns are on the build-to-rent multifamily transactions that we're contemplating doing here in the Southeast. So why would I want to take the risks of investing in Vietnam, the additional tax complexity, the exposure of liability and having to deal with Vietnamese courts if there's an issue? The familiarity of the U.S. is just so much better for me that unless I was going to get such a significantly outsized return, I don't want to do it. Whereas in the public markets, again, it goes back to time and effort. So they're liquid investments, they're publicly traded, they're publicly listed. You can get the information that you need, and so I have a greater comfort level. And I would say, in general, the vast majority of our clients also obtain their emerging market exposure through publicly traded vehicles, and they get their private investments based in the U.S. where they have greater comfort with the law, greater comfort with the culture, greater comfort with that, things are going to go as planned.
Okay, that's actually really good. I appreciate you explaining that. So unless you see the opportunity as such massive, beautiful kind of strategy, then it really doesn't outpace the risk and the reward associated with it. Let me ask you. You mentioned obviously the public traded. I do know some private equity. They have funds that are specific for emerging markets, Asia, and other different places. What is your thought process in regards to funds that are here based in like Carlyle or private equity that are based here, but then they deploy and infuse capital in those markets? How do you think about that? Do you find that the risk and reward it gives you some exposure to that, but in a more secure way?
Certainly could. It's better to have professionals on the ground that are representing you and your interests and not necessarily only representing the interests of the alternative party. So that's a better way to get that structure in place. But again, I'd look at what are the return profiles, and do those return profiles provide you with enough of an additional return that whatever the risks are, because there's currency risk involved, I would say is the biggest risk is, the US dollar has continued to be the strongest currency. And so as a result of investing offshore, if you were investing in another currency, you may have had good returns in that currency, but when you convert those returns back to dollars, they probably have lagged behind the US-based investment. So if what you're trying to do is get currency exposure, that's an interesting way to get your currency exposure and to diversify out of US dollars. And so that's just a bet that, the other economies' currency will perform better than the US dollar. And some people want to make that bet, especially now that the US dollar has been about as strong as ever. Even though it's a weak dollar, it's just the strongest of all the weeks. So.
Well, okay, so I see what you're saying. You really want to make sure that if you're going to have that exposure, you want to make sure you get some outsized returns to be able to obviously, offset that. Because what you're basically saying is that right now there are better still opportunities and better deals here in the U.S. that give you better, upside potential than, having to worry about too much of exposure or the tax liability, all that, all the other complexities of investing, externally from the U.S.
Yeah, and if you want currency exposure, there's plenty of ways to get it. So you may find that it's easier to get your currency exposure through like foreign currency trading systems than through private equity.
Well, I like how you think about it, Noah, because sometimes it is a contextual situation. Sometimes we see Israel or we see Saudi Arabia, they're making these leaps and bounds, or United Arab Emirates, and we're seeing all that potential and all that excitement over there. But we have to put it into context and say, well, what's the risk and reward? Is it worth the return? When here in the U.S. we can obviously get the same return, and we don't have to have all the complexity of it. So I just appreciate kind of sharing that thesis or alignment behind it. Is there any country that's kind of on the radar? I know you look externally outside, for direct deals as well as, other exposure. Are there any emerging markets that you are excited about right now? I know this is going to timestamp us right now, but I'd love to get your perspective just, on overall what you're seeing in regards to the emerging markets. I know ESG and impact investing is very sexy right now, AI, but I wanted to get your perspective on, do you gravitate mostly to real estate because you're very familiar with it, or you love to kind of, look at other opportunities that are kind of making you lick your lips?
Yeah, so I'm part of two global networks of entrepreneurs that I place a high value on. One is YPO, Young Presidents Organization, and the other being EO, Entrepreneurs Organization. YPO has 30,000 members around the world. EO has 15,000 members around the world. And so I'm exposed to global business ideas and global deal flow. But again, it's never really excited me. Going back to your thesis around, can you concentrate for your whole life and do very well in one niche, in one industry? I think so. Can you diversify away lots of risks and do well? I believe so. And so I think for my family, for the 8-figure net worth families that we counsel, we can base our investments, not exclusively, but the vast majority of our investment would be U.S. based. Even the S&P 500 index fund, which is probably the single largest holding for a lot of our clients, about 50% of the earnings of those S&P 500 companies come from outside of the U.S. So we get our international exposure through investing in U.S. based businesses, and then in addition we add some emerging market exposure, developed market exposure. But I've always found that the U.S. has been kind of the best place to be if you were a U.S. taxpayer, if you're spending U.S. dollars, if you plan to spend your lifetime here. And so, currency is a big part of that. There's a future where maybe the U.S. dollar is not as strong as it has been in the last 100 years, and I think that future is fast approaching, and our strategy may have to evolve with the times, but I don't think it's upon us yet.
Awesome. Noah, man, I really appreciate your time being on here. I know we kind of, bounced all over the place, but just unpacking your thesis in regards to, just helping us understand navigating the constant evolution of tax and how that's obviously always evolving, but how to take advantage of these different things and strategies that at the end of the day are very, very beneficial and are very underutilized for myself, but also for a lot of our audience members. And then as well as, pivoting to understand how you think about, your methodologies and how to think about that North Star and finding that North Star. And it's really dependent upon each family and each context and what that foundation looks like and what vehicles to utilize. And there's a lot of different strategy behind it, but helping us understand how Freedom Family Office really helps establish that with each one of your clients. Noah, for those that want to reach out that are looking to exit and have that dialogue before they exit, right? They don't want to be post-exit, like, hey, Noah, what's up? They want to be pre-exit. How do they reach out to you? How do they be part of what you got going on and learn more, man?
So anyone that just wants to stay in touch and follow the content that we create can reach out to me on LinkedIn. But if you're interested in having a conversation with me or our team about your personal situation, just go to talktofreedom.com, fill out a short intake form, and we'll get you on a call with the proper people on our team to talk about what's most important to you. I've got a bunch of free resources, and maybe if you have show notes, we could link to them. I could share them quickly if you think that's valuable.
Yeah, 100%. I'll put all those links in the description below, guys, for those that are listening, so you can literally just copy, paste, and put that in your URL and obviously click on that. I would highly recommend it. Noah is very active on LinkedIn, as well as he's got a lot of podcasts and then a lot of content on his website. So highly recommend just learning and listening and understanding what he's got going on, and obviously deploy it in your own business. So I would highly recommend reaching out to Noah. Noah, I really appreciate you being on here big time. And I want to ask before I let you go fully, if you think about that young Noah, I know you're third generation CPA and accounting side of things. And if you think that young Noah, imagine that young Noah, and what insecurities did you have to overcome to become the successful Noah that you are now?
So I had to let go of a self-limiting belief that in order to have a great life, I had to sacrifice my financial goals. And that's been a long evolution for me, but I've come to realize that I can actually have both, that the limitations I place on my willingness to invest in for-profit activities, work, so to speak, even though I limit the number of hours, and it's come down significantly over time, that doesn't limit my potential for what I could achieve in business. And in fact, I've kind of taken the reverse approach and said that by limiting my time, I'm helping accelerate what I can achieve because it requires me to build systems and teams to accomplish my goals without my involvement.
That is timely wisdom, and that is a lot of wisdom right there. Guys, that is the CEO and founder of Freedom Family Office, the financial advisor to the 0.5%, my friend, Noah Rosenfarb. Guys, that is Journey with Christian D. Evans podcast. Until next time, be uncommon if you can.